Monetary policy is all about, these days, is all about the manipulation of interest rates. So we've got a lot of interest rates that we could possibly be looking at. Does anyone know what the interest rate for credit card borrowing is right now? Okay, let's say about 18. What is it for a mortgage rate? Does anyone know that? So let's say 5. And you can see it's going to get lower and lower and lower. The official cash rate is the interest rate for borrowing money. This is not an interest rate available to you guys. This is the interest rate on borrowing money from the Reserve Bank of Australia, which is not something you can do, only banks can do that. And each of the interest rates after that, there's a little bit more risk attached to that loan. There's a bit of interest added on top to compensate for that risk, until we get to the credit card rates, which is the most risky kind of loan that banks can offer. And so they charge the highest interest rate for that to compensate them for their risk and to make profit as well. Of course, there's making profit all the way through. So how does the Reserve Bank of Australia seek to influence interest rates? How do they do it? There's daily fluctuations in the demand and supply for money in the short-term money market. Short-term money market's a 24-hour money market. Some days there'll be surpluses, some days there'll be shortages of money in private bank settlement accounts. Private banks borrow and lend off each other and off the Reserve Bank every day. So they have these settlement accounts. And at the end of the day, each bank will either have a shortage in its settlement account or a surplus in its settlement accounts. If it has a shortage, then it'll need to borrow money to cover that shortage for the day, for the end of the day. And it's at this point, this kind of weak point, so to speak, that the Reserve Bank can manipulate the interest rate on the borrowing of money to cover settlement accounts by the private banks. So the Reserve Bank can use what are called open market operations. Open market operations basically boil down to buying and selling bonds, government bonds, to the private banks in order to manipulate this short-term cash rate. Let's say the Reserve Bank wanted to increase the interest rate in the short-term money market, this 24-hour money market. The way they can do it is that they will create a shortage in the short-term money market. What happens to the price of borrowing money? The interest rate, it goes up. So what the Reserve Bank does is it creates a shortage. How does it create a shortage of money? It sells government bonds, and in exchange, they give money to the Reserve Bank. That's now gone. Now the banks have a shortage of money because they've got pieces of paper instead. So now there's a shortage of money. So the price of money in the short-term money market, the interest rate in the short-term money market increases. And if the Reserve Bank wants to cause the short-term interest rate or the official cash rate to fall, they create a surplus of money. The way they create a surplus of money is they buy government bonds from banks and give them money. So they have surplus money. When there's surplus money, the price of borrowing money falls, the interest rate falls. So when the Reserve Bank manipulates this short-term money market and therefore manipulates the interest rate in this short-term money market, the price of borrowing money between the banks each day, that flows through to the interest rates that they charge to their customers. If they have to pay higher interest rates to each other in the short-term money market, they will pass on those costs to their customers. And so all of these interest rates will all get shifted up, right up to the credit card. From the home loan right up to the credit card, they all get shifted up. All due to the Reserve Bank of Australia manipulating the short-term money market and thereby manipulating the banks. So, why does the Reserve Bank want to manipulate the short-term money market in order to manipulate the banks, in order to manipulate the interest rates the banks charge? because interest rates affect the macroeconomy. If the Reserve Bank looks into its crystal ball and sees that inflation looks like it's starting to get too high, what does too high mean? Too high means more than 3%. If inflation's starting to crawl above 3% and it's not projected to go back down again, then the Reserve Bank will say, aha, we need to do something, because it's part of our job to keep the inflation rate in the range of 2 to 3%. So what can we do? We will use contractionary monetary policy. We will try and contract expenditure in the economy so that there will be less pressure on prices to rise. How do we do it? We use our open market operations. We will sell bonds to the banks so that the cash rate rises. The cost of borrowing money by the private banks rises. They pass on that higher cash rate that they have to pay to their customers, households and firms. So bank interest rates rise. When bank interest rates rise, consumers can't afford to buy that new washing machine or that new car or that new plasma screen TV anymore. So consumption spending falls. Interest rates rise, businesses can't afford, or that investment project that they were looking at doesn't look like a viable one anymore. The profit they would make on it would be less than the new higher interest rates they'd have to pay. So the expenditure on investment starts to fall. And net exports start to fall, as well as the exchange rate, the value of the Australian dollar, starts to rise. Because C plus I plus NX have all fallen, overall aggregate demand will tend to have fallen. If aggregate demand falls, then businesses cut back on production. GDP falls. Unemployment tends to rise, an unfortunate side effect. But there's less pressure on prices. This was the real objective of the exercise in the first place. There's less pressure on prices. Pressure on prices falls. So the inflation rate falls back to within the target range. That was the objective. And of course we can see it graphically. So here's our economy bubbling along in equilibrium, but it turns out that price level is above the target level. The Reserve Bank spots this and says, we need to do something, we need to get the price level back to the target level. So it increases interest rate, it sells bonds, that increases the cash rate, that causes banks to charge higher interest rates, that causes consumers to decrease consumption spending, businesses to decrease investment spending, and net exports to fall. So aggregate demand falls, decreases, shifts to the left. The economy is now in disequilibrium and it gravitates to its new equilibrium point. Where is that new equilibrium point? Well, aggregate demand has fallen. Businesses realise that there's not as much expenditure as before. They cut back production. GDP falls. But because GDP has fallen, the marginal cost of production has also fallen, so the firms can charge lower prices than before. Prices tend to fall. They tend to fall towards the target, which was the point of the whole exercise, until we get to equilibrium. And if everything's gone according to plan, then the Reserve Bank has increased interest rates just enough to cause precisely the right decrease in aggregate demand, which causes precisely the right decrease in the pressure on prices. So this is contractionary monetary policy. And then, of course, there's the opposite of that. What if inflation is projected to be too low? Too low would be what? Less than 2%. If the inflation rate were 1% or 0.5% or 0%, and the Reserve Bank projected that it wasn't going to go back up again into the target range, then they might decide we need to do something about it. We need to expand the economy. we need to inflate prices. How are we going to inflate prices? We need to manipulate aggregate demand. We need to manipulate expenditure. So, the Reserve Bank manipulates the short-term cash rate. How does it do it? By using open market operations, it buys government bonds from the banks. The price of the money in the short-term money market, the cash rate, falls. When the cash rate falls, if everything else remains equal, ceteris paribus, then the banks pass on the savings to you in lower interest rates. So the cash rate falls in the short-term money market. Banks pass that on as lower interest rates to businesses and households. Businesses and households can now afford to borrow more and therefore to spend. So households spend more on credit, consumption spending goes up, and businesses spend more on investment with credit. Investment spending goes up. Also, the value of the Australian dollar falls, and as a result, exports become more competitive, net exports rise. All of these, C plus I plus NX all rising, contribute to aggregate demand rising. When aggregate demand for goods and services rises, businesses respond how? They respond by producing more. Real GDP, represented by Y, rises. Some unemployment is sucked up as a result, which is a nice side effect. But more important than that, the point to the whole exercise from the perspective of the Reserve Bank was that prices are inflated. That was their objective. Remember, we started off, inflation projected to be too low. We want to push prices up. This was the aim of the whole game. Graphically, what's going to happen? The actual price level is lower than the target. The Reserve Bank realises it. They think we've got to inflate prices. We can inflate prices by decreasing the cash rate. Decreasing the cash rate means businesses will be charged lower interest rates by the banks, and households will be charged lower interest rates by the banks. They will expand their demand for goods and services. Aggregate demand shifts right. The economy is now in disequilibrium. It's got to move to its new equilibrium point. Aggregate demand has risen. Businesses realise we need to increase production to satisfy this higher demand. They increase production. But in increasing production, the cost of each additional increment of output rises. Marginal costs increase. Firms need to charge higher prices to cover those higher costs. So they charge higher prices. So the price levels start to inch up towards the target, which is the Reserve Bank's aim. Until, if everything goes according to plan, the economy reaches equilibrium at a price level which is the target of the Reserve Bank.